Hi, I'm Ben Shepard, the editor of Lewis Rue Cottage Mutual Funds. Small caps have been on a tear so far this year. The Russell 2000 is up about 23% year to date. So today we're joined by Sam Dedio, portfolio manager of Artio US Small Cap, to get an expert's take on what's going on in that space. As we said, the small caps have been faring really well, and that's not totally unexpected at this point in the cycle. But given the tough business environment, do you think that rally still has legs, or are we starting to falter here?
I do think that the rally can continue. We have to keep in mind last year small caps outperformed the large cap index. So in other words, the Russell 2000 was down like 33%. The Russell 1000 was down 37%. I think the S&P was down a comparable amount. So you had some outperformance last year. So this year it stands to reason that even though it looks like we're heading toward a recovery, the small cap outperformance might be somewhat muted, but I do believe that if we continue to see signs on the road that the economy is improving, the small cap outperformance will start to appear more readily in terms of the delta between the Russell 2000 and, say, the S&P 500.
The past few days, the Russell 2000 has been faltering a bit as we're going into third quarter earnings season. Do you think there's a real reason to be concerned there for the small caps, generally speaking, or are we looking just to take a breather?
I don't think, when I look at the averages, it seems to me there's certainly more risk with small caps. So on down days, they tend to be down more than, say, the S&P 500. Small caps as an investment class are riskier. So investors should know that if you look at the long-term performance of small caps, going back to the 1920s, on average, you should expect about 200 basis points more of outperformance with small cap stocks versus large cap stocks. The price you pay, though, is greater volatility. So when there's a period in the market, when there's a funk or the market's not acting well, typically small caps will underperform and they'll look optically worse than large cap stocks. That's just part of the territory of going for that, reaching for that extra return level you get with small caps. To me, it's been nothing out of the ordinary. The market seems to want to rally at the end of most of the days, or if there's losses, it somewhat cuts the losses. So it feels like the mirror opposite of last year, where market would start up, try to be positive, and then roll over. Roll over, get worse as the day went on. This market seems to be just the opposite. So it tells me that people are more interested in it now than last year on the buy side. And with the earnings coming out and a lot of the earnings surprises, I think it'll be challenging to really get short in this market environment. So I do think there's a bias to the upside and being long.
Are there any particular sectors within the small cap universe that are looking more attractive at this point than others?
Sure. When I look at the sector performance this year, in small caps, the financials have been lagging. Industrials have lagged. Technology's been strong. Consumer discretionary has been strong. Healthcare has been men's and men's. It's been really in the middle. We think that as the recovery takes hold, the leadership will evolve and will change. And some of the areas we find interesting now to explore, and we're doing more work, and include industrials and some healthcare and also some financials. We think that commercial real estate at some point will be an attractive investment again. The problem is now you're seeing a lot of headline news on declining rent rates, increasing vacancies. So there's a lot of macro and high-level data that's coming out. It's negative, but the stocks are kind of percolating along the bottom, starting to bounce up a little bit. So traditionally, the pecking order is stocks will lead. So the stocks are typically leading indicators. So you see the stocks perform well first, then you'll see the company fundamentals improve, and then you'll see the macro data come together and be clearer for a broader call on what's happening. So we pride ourselves in trying to be early. We don't mind being a quarter or two early of something we think that'll emerge and be powerful over the next 1 to 2 years, which is typically our time horizon. We have a very seasoned analyst team that really looks at the market by sector. So we have a dedicated analyst looking at the financials. We have a dedicated analyst looking at the industrials and looking at the opportunities within the industries. So I feel like we're really prepared for it. But we do think that the hunting ground for the next 2 years, where the most opportunities for the best alpha will be within the financials and the industrial sector as we look out over that time horizon.
I understand that your fund is very much driven by fundamentals. Can you maybe talk a little bit about how you make your investment selections?
Sure. we are fundamental bottoms up investors. So we kind of look at each company on its own, and the greater the amount of opportunities we find in the sector, that will really dictate our overweights and underweights in the portfolio. But some of the individual characteristics we like to look for within our universe of companies across multiple sectors, we like to try to find companies that have products or services that change the behavior of the spender, whether it's a consumer or whether it's a capital spender. Really try to find products that are differentiated, that will cause a company to, especially in this environment, gain market share, maybe at a quicker pace than its competitors, or carve out a new niche, a new market opportunity. So that's a good starting point for us. We also pride ourselves in understanding the cash flow dynamics of a company. Try to find companies with economic earnings or companies that generate free cash flow. That's an important part of our process, to make sure we understand how a company is generating a profit, not only from a GAAP accounting standpoint, but also from an economic standpoint in terms of the impact to the balance sheet cash and the overall cash flow of the company. The last thing I'll tell you is part of our process, we make sure we're diversified across multiple sectors. We view diversification fundamentally in really three arenas. The first way is, as I mentioned, sector diversification. So we try to have representation of all the Russell or S&P sectors. We tend to avoid utilities because they're highly levered and low ROIC companies with long-term performance has been actually below average for the market. So we tend to have a bias to avoid utilities. But beyond utilities, we try to stay diversified across sectors. And we try to be more from an approach of a style, a core manager, not a growth manager. So we'll have more representation across sectors, but it'll be flatter, whereas a growth manager might have tech, healthcare, and consumer be 70–80% of his or her fund. We're more like 50–55, 60% for tech, healthcare, and consumer. We have a larger financials weighting than the average growth manager. So we really strive to stay diversified by sector. The second category of diversification is we make sure that the portfolio has companies of all different sizes. So we have the smaller, riskier small caps. We also have the higher quality small caps that might be ready to graduate to mid cap. So on size, on our market cap, we make sure we're diversified. And last method of diversification for us is to ensure we have companies with leverage and companies without leverage. So some people define them as high quality growth companies, typically have no debt, and they just redeploy their profitability into expanding sales and geographies and traditional growth company. We also look for values and investments in the value camp, where the company, the equity might be really mispriced because they have a lot of debt, they have a lot of leverage. The market was very concerned, as you probably know, in the third quarter last year, fourth quarter. It seemed like the trade was sell all companies with debt, and if you're a hedge fund, short those companies that have debt. And we saw that, we looked at our performance, and our performance was really starting to cause us some concern because we're underperforming, and we found out that was all our leveraged companies were underperforming the market. So what we did was we looked really long and hard at our portfolio to make sure we wanted to own those companies that had the debt and that the equity was really mispriced, and we wanted to validate that. And we did, and we actually benefited from the return of the investor to those companies with debt. That's happened, so far the 9 or 10 months this year. People have started to gravitate back toward those companies with leverage that, lo and behold, they're not going to go out of business. They're going to restructure some of the terms of their debt. Banks would give them a new agreement, maybe at a higher interest rate, but they would not go into bankruptcy.